Gold prices slumped 28% in 2013, and the World Gold Council just came out with its fiscal year gold demand trends report. Here to talk about with me today is Will Rhind of the World Gold Council. Will, thanks for being here.
Thank you, Joe.
So, Will, your report found that gold demand dropped 15% in 2013, mostly due to selling in ETFs and central banks. So my main question is, why didn't we actually see more central bank buying when gold was at its lowest price in many years and biggest drop in 30?
It's a good question, but I think as a point of principle, central banks are not really in the business of market timing. So from that perspective, the fall in the gold price had a uplift in volatility in the gold market, and when that happens, that causes institutions like central banks to pull back from the market rather than to participate further in it. So we saw the velocity of purchases by central banks reduce, but they still remain net buyers last year, 2013, and now have been net buyers for 4 years in a row.
Sure. Do they stay net buyers in 2014 because this lower price is realized and they do feel like it's a good opportunity to buy?
Well, I think that central banks generally are driven by policy decisions, and those tend to be over long-term cycles. So we do believe that in 2014, we expect central banks to remain net buyers of gold through this year.
ETFs were a huge reason that we saw such a big drop in gold prices in 2013. We saw outflows of 880.8 tons that you guys had reported. First off, do you see this being a trend into 2014 as well?
Well, I don't think so, at least not with the same kind of veracity that we saw in 2013. And we have named 2013 the year of the consumer because while we saw a reduction in demand and outflows from ETFs here in Western markets, US in particular, that gold moved to Eastern markets, and particularly China, where it was consumed in the form of bars and coins.
Sure.
And other forms of gold demand.
Yeah, the physical demand. So real quickly then, why did we see such huge outflows specifically in the ETFs? And is this really kind of a new phenomenon that you guys are watching?
Well, ETFs are fundamentally a access tool for the gold market, and for all of the ease they've made, the easiness that they've made their access to gold, the flip side is that investors can also sell gold easily through the ETFs. And ETFs allowed investors to do that last year, and that was largely on the back of concerns over the Fed tapering, and the Fed indeed starting to implement the tapering policy, which people saw as being negative for gold. Now, gold was really the main asset class that was affected by this sort of anticipation of tapering. And so once we got to the eventual taper, we saw gold prices didn't drop in the way that some people might have expected. And we think that that was largely because that move was priced in.
Right, and something we've seen with more taper in January. Janet Yellen has already said they'll continue the taper. Prices continue to go up in 2014 by almost 10%. Will Rhind, thanks so much for being here with us.
Thank you, Joe.
That's Will Rhind of the World Gold Council for TheStreet. I'm Joe Deaux.